All right, let's dive in. Today, we're opening up a really powerful but often kind of misunderstood toolkit that businesses use to reshape their entire structure. We're talking about corporate reorganization. Let's see how it's done. Okay, first things first. Let's set the stage. When a company wants to move its assets, it really has two main paths. It can do a simple sale, right? Convert business assets into cash. But, and this is the absolute kicker, that can create a huge immediate tax bill. A reorganization, though, that's a whole different ballgame. It's about changing the form of the business, not its core substance, and that allows you to hit the pause button on that taxable income.
So that brings us to the big question for today. I mean, you see these massive companies merging all the time, or a single business splitting itself into brand new entities. So how on earth do they pull off these incredibly complex moves without getting slammed by a giant immediate tax event? Well, the answer is by using a corporate reorganization. The key principle here, the magic words, are continuity of interest. The idea is that because the same owners are basically continuing the same business, just in a different legal shell, the tax rules let them defer the tax that would normally pop up from a sale. It's a strategic shuffle, not a cash out. So now let's actually open up this toolkit. Our first and most straightforward tool is the asset transfer. You can think of this as the scalpel in our kit, the precision instrument for moving very specific pieces of a business from one corporate box to another. And the real power of this tool is its flexibility. An asset transfer isn't an all-or-nothing deal. A company can decide to just carve out a single division, or maybe just a specific group of assets, and move them over to another corporation, leaving the rest of the business totally untouched. And these transfers basically come in two flavors. A vertical transfer moves assets between a parent company and its subsidiary. It's a simple move up or down the org chart. A horizontal transfer, on the other hand, shifts assets between two sister companies that happen to share the same owner. And believe me, the choice between them has some very real consequences for who's in control and what the ownership structure looks like. Okay, let's grab our next tool. This one isn't about moving little pieces around, it's about total fusion. We're talking about amalgamations, the process of completely merging two or more companies into one single brand new entity. And this process is absolutely final. In an amalgamation, the old corporations legally just cease to exist. They're dissolved. And from that combination, one new corporation rises, carrying forward every single asset, liability, and shareholder from the companies that came before it. But to get that sweet, sweet tax-deferred treatment, you've got to play by some very strict rules. For example, in Canada, all the companies have to be Canadian. And across the board, everything, we're talking all assets and all liabilities, has to move to the new company. And crucially, all the former shareholders have to become shareholders in the new company. It's all about maintaining that continuity of interest we talked about earlier. So why go through all this trouble? Well, one of the biggest strategic advantages is being able to combine financial positions. Let's say you have a company with big profits, and you merge it with one that's racked up a bunch of tax losses. The new combined corporation can then use those old losses to shield its future profits from tax. It's a really powerful move. Our third tool is a bit more of a specialist. It's called a wind-up, and it's designed for a very specific job, when a parent company wants to completely absorb one of its subsidiaries. So what's the real difference between a wind-up and an amalgamation? Well, it's all about who survives. In an amalgamation, a brand new company is born. But in a wind-up, the parent company just keeps on going. It simply absorbs the subsidiary. There's also a pretty high bar to clear. The parent has to own at least 90% of the subsidiary's shares to use this tax-free method. This leads to a pretty fascinating question. What if the parent company paid a really high price for the subsidiary's shares, maybe years ago? Is there a way to reflect that higher purchase price in the value of the assets it's now absorbing? I mean, can a merger actually create new tax value out of thin air? The answer is yes, and it's done through something called a step-up, or more informally, a bump. And this is a huge benefit. It allows the parent to literally bump up the tax cost of the subsidiary's assets that don't depreciate, things like land, to better match the original purchase price of the shares. This creates a higher cost base for the future, which can save a lot of tax down the road. So how does it work? It's basically a two-step process. First, you calculate the available increase by figuring out the difference between what the parent paid for the shares and the subsidiary's net assets at their tax value. Then you get to allocate that increase to specific assets. But, and this is the key, you can only bump them up to what they were worth at the time the parent first bought control. Okay, our final tool is different. It doesn't involve moving assets between companies at all. Nope. Instead, share reorganizations are all about changing the ownership structure within a single company. Let's just walk through this example because it's pretty neat. Imagine two partners, 50-50 owners. First, they freeze the company's current value by swapping their common shares for preferred shares that have a fixed value. Since all the value is now locked up in those preferred shares, the company can issue brand new common shares for next to nothing. The partners then buy these new shares, but this time in a new 80-20 ratio. And just like that, they've completely changed how all future growth gets split without triggering any immediate tax. It's Brian. So we've got our 4 tools: asset transfers, amalgamations, wind-ups, and share reorganizations. But knowing the tools is only half the battle. The real art, the real strategy, is in choosing the right one for the job. Professionals don't just pick a method out of a hat. They follow a really rigorous 4-step process. First, you define the problem. What are we trying to fix? Then, you test a potential solution. You map out every single one of its consequences. Third, you analyze. Did that actually solve the problem, or did we just create new ones? And if it's not perfect, you go back to the beginning, pick another tool, and repeat the whole process. It's a systematic way to find the absolute perfect move. And that really leaves us with a final thought. These tools aren't just for massive, faceless corporations. These principles apply to businesses of all sizes. And it makes you wonder, doesn't it? Is your company's current structure a strategic asset that's maximizing its potential, or is it maybe just an old setup that's actually holding it back?